Hey everyone, Kyle here. If you've formed an LLC to protect your real estate deals but never look twice at the operating agreement, you might be sitting on a legal landmine. In this video, I'll be breaking down 10 stupid but fixable mistakes that I see in agreements, operating agreements, and everything having to do with LLC. From giving creditors a free shot at your assets to even losing control of your own properties when a partner's life blows up. Make sure to stick around and grab your current operating agreement because we're going to be walking through each flaw step by step. That way you can patch them up before they cost you cash, privacy, or even your actual income. Now let's get started with the first mistake, which is going to be locking yourself into a member managed LLC structure. This might sound like a democratic choice where everybody gets a vote on every decision, but in actuality, it's kind of a nightmare to actually work with. The second that wording hits your state filing, each member's name and address become public record, slicing away the privacy formed when an LLC actually gets you. The worst part of this is that you can't refinance, sell, or even gift a property without unanimous consent of your members, which basically means that one absent-minded cousin or a partner going through a messy divorce can basically freeze your entire portfolio. The easiest way to fix this is to add an agreement to your member managed LLC and list as a single manager. That can be either you or even a shell entity, and move all day-to-day authorities like signing deeds, hiring contractors, and securing loan amounts under that role. Members will still own their percentage here, they just stop being speed bumps every time you need to make a decision. File this change with your Secretary of State, update any bank resolutions in your anonymity, and control snap back into place. Now, mistake number 2 is baking forced distributions into your operating agreement. This is basically language that says profits or even just enough cash to cover members' tax bills must be paid out every single year. On paper, it definitely feels like a fair thing, but the moment that somebody sues a member inside of your LLC, and even worse, wins a charging order, that creditor can step right in and basically snatch those required payouts, ultimately siphoning money out of your LLC altogether while you're pretty much powerless. Even if a lawsuit shows up altogether, you're basically going to be handcuffed to your own growth curve. A good example of this is that maybe a killer off-market duplex pops up and you need to keep cash inside the entity in order to make a critical decision for buying that property. But unfortunately, the agreement that you sign now forces you to empty the bank account every single year, no matter what the case is. One of the easiest ways to fix this is to basically take out that mandatory distribution clause and replace it with contract language that makes payouts purely discretionary, which basically means that managers decide if, when, and how much actually payouts are happening. This single tweak basically blocks creditors from grabbing cash and lets you reinvest profits on your timeline instead of a calendar that the IRS or an ex-partner loves more than you do. Now, mistake number 3 is locking in pro rata distributions. Basically, this is language that says that every dollar must be split strictly by ownership percentage, no matter what's happening in a member's personal life. That might sound pretty impartial until one partner heads into divorce court. The judge might tag their membership interest, and then suddenly your LLC is cutting checks that land in your ex-spouse's pocket. The same clause here can force you to pay a passive member who isn't pulling their weight or drain reserves you'd rather park in a new roof or a cash out refi. You can basically swap that rigid rule for flexible distribution language. Profits get allocated on the books by percentage, but actual cash goes out only when the manager deems it necessary and can be withheld from any member whose interest is tied up in litigation. You keep control of liquidity, starve predators circling a member stake, and preserve cash for real opportunities just so that way you don't actually get stuck up in court-ordered leakages. Now, mistake number 4 is ignoring change order language altogether, which leaves the door wide open for a creditor creditor to grab more than just passive rights. If they ever seize a member's interest without a clear cause, that demotes an outside creditor to assignee-only status, which basically means you have no vote, no management voice, and no access to your books. That third party could basically snake its way into full membership powers. They can also call meetings and even force asset sales to satisfy a judgment. Make sure to drop a very tight provision into your agreement that says that any involuntary transferee only will receive economic rights and nothing more. And it explicitly prevents them from voting or demanding information. This single sentence keeps hostile creditors in the hallway, lets you continue running the portfolio without interference, and preserves the charging order's main benefit, which is basically turning the LLC into a cash-dry desert for anyone who thinks winning a lawsuit equals an instant payday. Now, for mistake number 5, we're going to be looking at what happens when leaving membership transfers and how that can affect your LLC. These leaving membership transfers can actually make your LLC super vulnerable to issues. This basically means no right of first refusal, no approval huddle, or just basically no meeting. That means if a partner gets sued, divorced, or simply wants quick cash, their units can land in a stranger's hand and you could wake up sharing ownership with a creditor, an ex-spouse, or someone who doesn't understand cap rates. You can patch this hole by adding a transfer restriction clause where any member who wants to sell or is forced to assign their interest must first offer it to the LLC or the remaining members at fair market value, and any involuntary transferee only gets economic rights until a supermajority vote admits them. That safeguard keeps your circle tight, preserves decision-making chemistry, and prevents your investment from turning into a courtroom swap meet. Now, mistake number 6 is going to be including any tax language that clashes with how the LLC actually files with the IRS. Say the agreement calls the entity a partnership, for example. Meantime, you've elected S-Corp status to run payroll and self-employment tax. This mismatch is basically a huge plus for auditors and a goldmine for litigators who will argue that your books are a mess and basically the corporate veil should be pierced. You can then go ahead and pull a copy of your last 2553 or 883 election, match the wording in the operating agreement to that choice, and add a line to it giving the manager power to file future elections that optimize taxes without any unanimous votes. Consistency here is going to give the IRS a much more easier look on your business and help if things are ending up going to a courtroom. Now, for mistake number 7, we're looking at promising members an unconditional right to pull out their initial capital whenever they want to, or even worse, whenever a creditor wants to. Courts basically love this clause because it turns your LLC into a personal ATM that they can tap to satisfy a judgment. They simply step into the member's shoes and in the return of capital, draining operating cash and forcing asset fire sales. So make sure you delete that right to return of capital language and replace it with a more discretionary framework. Something like capital comes back only at the manager's option and it's subject to solvency tests and lender covenants and is subordinate to any other charging order claims. This rewrite preserves liquidity for renovations, reserves, and opportunity buys while starving predators of an easy cash lever. Now, mistake number 8 here is going to be skipping officer appointments pretty much altogether, leaving every contract, lease, or refinance to be signed under your personal name as manager. That basically kills 2 strategic perks here. Number 1 is going to be anonymity, and number 2 is delegation. In states like Nevada or Wyoming, officers are not part of the public record. So designating yourself as one, as president or secretary, keeps your real identity off ultimately searchable filings. Internally named officers create a much cleaner hierarchy that lenders and titles companies respect, letting you hand routine signatures to a secretary while you can focus on acquisitions. Now, for mistake number 9 is forgetting a death or disability clause, which is a brutally common oversight that leaves surviving members pretty much scrambling if one of your partners dies or becomes incapacitated. Without clear language on this, the deceased member's interests basically basically slides into probate, giving heirs who may know nothing about real estate a voting seat or even forcing a liquidation to divide assets. Meanwhile, lenders can actually call loans due because the original guarantor is basically not alive anymore, and deals in escrow can pretty much stall out while lawyers trade paperwork with each other. You can make a very easy fix for this by adding a buy-sell provision. On death or permanent disability, the LLC or remaining members have the right but not the obligation to purchase the departing members' units at a pre-agreed valuation formula: appraisal, cap rate, multiple, or insurance proceeds. Pair that with a key person's life or a disability insurance so the liquidity is there when tragedy actually unfortunately could strike. This single clause is super important and can protect your LLC just that much more. And for mistake number 10, it's going to be treating a boilerplate template as gospel and never revisiting it. Most investors grab a free operating agreement on the internet or even have something like ChatGPT write it for them. But of course, this is never a good idea. It's always important to consult with someone who is a legal professional, who can look over your operating agreement, find any loopholes, and make those fixes. Speaking of operating agreements though, if you're interested in getting started with your own, I'd highly recommend checking out the links down in the description. You can basically get your very own operating agreement with a service like Northwest Registered Agent or even LegalZoom. Both of these services will be linked down in the description. You simply click those links, and as you can see here, they have a $39 business formation service for LLCs, corporations, or even nonprofit companies. And if we check out LegalZoom, they have another very similar promo with some great deals involved. Make sure you use those links down in the description. If you guys enjoyed this video, make sure to leave a like and comment down in the comment section if you have any questions. Also, make sure to hit that subscribe button so you don't miss any of our future videos. And of course, please remember the links down in the description are affiliate links, and we could earn a financial benefit from them at no extra cost to you. Thanks in advance for watching this video, and I can't wait to see you guys in any of our future videos.